Hey guys, thanks for joining me today. My name is Will Lopez, founder of advisorfi.com. Today we're going to talk about reasonable compensation. That is, you own an S Corp or you have an LLC and an Inc. and you've elected S Corp status and you need to run payroll. So we're going to talk about the IRS's definition of reasonable compensation, and we're going to ask ourselves two very important questions here today. The two questions we're going to ask ourselves is, how do we determine a salary as a shareholder employee? So if you have an LLC or if you have an Inc. and you've elected S Corp status, you are considered a shareholder employee of that S Corp. So how do we determine a salary as a shareholder employee of our own S Corp? And the second question we're going to ask ourselves is, why do we care? Well, we should care greatly because the IRS cares greatly about this issue, and we're going to go over that here today in this video talking about reasonable compensation. But before we get started, if you'd like to schedule a free 30-minute consultation with our team, feel free to click on the link below, which is in the description, or you can go to a web browser and type in meetme.so/freebie for a free 30-minute consultation with us. All right, so let's get started. So, paying yourself. Very important question you need to ask yourself if you've elected S Corp status, if you've seen any of our other videos which we talk about S Corp statuses and how to elect S Corp status and why we should elect S Corp statuses because of the potential tax savings. Very important next question that you need to ask yourself is, well, I need to pay myself because the IRS has said, you know, if you're going to save all that money, well, you need to start running a wage, and a wage is considered compensation, and you need to run reasonable compensation. So today we're going to ask ourselves, well, we need to pay ourselves. Well, the procedures generally for compensating yourself for your efforts in carrying on a trade or business will depend on the kind of tax classification you elect. So before we even get into this conversation of reasonable compensation, if you've not seen our video about tax classifications and corporate structures, be sure to click on that. To watch that video entirely, you'll have a better understanding on corporate structuring and tax classifications. So, but in this conversation of paying yourself reasonable compensation, compensation is going to depend on the tax classification that you elect. And so we're going to cover that really briefly here. So the first tax classification that people generally fall into are sole proprietorships. I'm sure you've heard this term floated around. It generally happens when you are an LLC. When one person owns an LLC, the default tax classification for that is called sole proprietorship. It also happens when you're a non-LLC. If you're just going around and making money, you're selling things on Etsy, you're selling things on eBay, you're selling things on Craigslist for a living, and you're making an income, you're considered a sole proprietor. The second type of tax classification that's out there is considered partnerships. This also happens when two or more people own an LLC, or two or more people go into a business together that's not really covered by an LLC, but they're considered a partnership. And this is also a tax classification that you need to consider how to pay yourself on. The third kind of tax classification is called corporation, generally called C Corp status. This happens at the LLC level when you fill out Form 8832, and at the Inc. level when you fill out Form 88. Generally, as an Inc., the default tax status for an Inc. This is also known as a double tax corporation. You also have to consider reasonable compensation. And the last tax classification that which this video is actually going to cover, is S corporations. So S corporations is not a default tax classification for LLCs or Incs. Now, S corporation can be elected by LLCs by filing Form 2553, which we have a video on how to do that, and by Incs by filing Form 2553. So if you're watching this video and you've elected S Corp status and you're an LLC or an Inc., then as an S Corp owner, as a shareholder employee, you need to consider how to pay yourself, and that consideration is called compensation, and the IRS cares about how reasonable that compensation is. So let's dive into reasonable compensation. Let's dive in actually into the definition that the IRS gives for reasonable compensation. And generally it's called this: because an officer of an S Corp is generally an employee with wages subject to withholding. Now, withholding is code for withholding federal income tax, federal Social Security tax, and federal Medicare tax. So because an officer, and you're an officer, you're a shareholder / employee, and because you're the employee, you're the highest level of the employment, which is officer. Because as an employee, you have wages that are subject to withholding, corporate officers may question what is considered reasonable compensation for the efforts they contribute conducting their trade or business. Basically, here's the breakdown. You own your S Corp. You obviously work for your S Corp. You generate income as the owner of the S Corp, whether it's through an LLC or an Inc. You are contributing, you're conducting business for the S Corp. You need to be compensated in exchange for your contribution to the business. And so you need to consider what reasonable compensation you need to pay yourself for the efforts that you put into your business. And the IRS very much so cares about how you determine reasonable compensation. So what is reasonable compensation as we go through this video together? Well, according to the IRS, salary paid to a shareholder employee in turn in exchange for services that the employee provides to the corporation. That's basically the IRS's definition of reasonable compensation. So basically, Form W-2, like a job, right? So if you're currently working at a job, you get paid a wage, you get paid a salary, you get paid hourly. That job submits in quarterly payroll tax documents federally, quarterly payroll tax documents to the state. As an employee, you don't see that aspect of it, but as the business owner and as the shareholder employee of an S Corp, you're now going to start seeing that kind of stuff. And as a shareholder employee, you need to pay yourself a salary in return for the services that you provide to the corporation. Well, you may ask yourself, well, what am I providing to the corporation? Well, you're actually providing a lot. You're running the corporation. You're going out, closing business, doing business. And so the IRS is very concerned about how you pay yourself through a salary, especially as the shareholder employee. Now, this very much so doesn't apply to employees that are non-shareholder employees, right? Just employees in general, people who don't own your S Corp, they're not co-owners. This only applies to officers, people who own equity in your business is where you need to make a determination for reasonable salary. Obviously, if you have employees, your state may mandate minimum wage. So you can't go below minimum wage as far as your employees are concerned. But as you, the officer, you need to actually come to some sort of calculation that determines reasonable compensation, generally, obviously, greater than minimum wage, but you'll need to find what that is. So let's continue as we talk about basically why you need to pay yourself reasonable compensation. Well, according to the IRS, S corporations must pay reasonable compensation to a shareholder employee in exchange for services that the employee provides. So we just talked about this in the last slide. So why you need to pay yourself a wage through your S Corp is, if you've seen any of our other videos, is basically this. An S Corp does not pay self-employment tax on its profits. Self-employment tax is considered Social Security and Medicare tax. So the United States, all employees, all individuals here in the United States pay 3 federal taxes: federal income tax, federal Social Security tax, federal Medicare tax. And those 3 taxes are basically applied to things called compensation. And compensation generally is a Form W-2, generally applies to sole proprietorship income. Now, when you elect S Corp status, you don't pay Social Security tax, Medicare tax on the net income of your S Corp. And the reason why you don't pay that is just the way the tax code is written. If you've seen our other videos, you can learn a little bit more about that. But because you don't pay Social Security Medicare tax, they're not going to let you walk away with not paying Social Security Medicare tax. They now require, demand that the employer of the company, that is your company itself, pay the shareholder employee a reasonable compensation, which is Form W-2 wages, that is official payroll wages, and through payroll you pay Social Security and Medicare. So you see, the IRS you don't get away with not paying Social Security and Medicare, but what happens is you end up saving a lot of money through the S Corp status, and then you start running a wage which is much less than your profits. And so the difference between your W-2 and the profits of the business, that profit of the business avoids or basically does not pay Social Security and Medicare, but your W-2 does. So whereas a sole proprietorship, all your net income pays self-employment tax. When you elect S Corp status, all the net income no longer pays self-employment tax, but now the IRS says you must pay yourself a W-2 wage, and inside the W-2 wage, you pay self-employment tax. So going on, IRS basically has some factors in determining compensation. So you may ask yourself, well, okay, how do I figure out what to pay myself? Like, how do I determine reasonable compensation? The IRS talks about reasonable compensation. The IRS mandates that you pay yourself a reasonable compensation. They require that the shareholder employee pay themselves a reasonable compensation. But how do I determine that? Well, the IRS, unfortunately, is not going to tell you what to pay yourself. Now, there's a bunch of case studies out there that basically where individuals have basically committed tax fraud. That is, they've had S corporations, and on their S corporation corporate tax return, they said they paid themselves a W-2, but on their personal tax return, they did not. Where things like that, or many times the IRS will impute or impose a W-2 wage. That is, some people abuse the S corporation status, and they'll pay themselves $10,000 a year in W-2 wages, yet they make $1 million a year. And so obviously not reasonable considering how much they're making per year. And they'll go back and they'll say, well, you paid yourself $10,000 a year in W-2. You really should have paid yourself $100,000 because of your specific situation. Therefore, we're going to impute the difference of $90,000. We're going to reallocate your distributions as salary, and now you're going to owe us back taxes, Social Security, back taxes, Medicare, penalties, interest, fines, so on and so forth. So the IRS does provide people guidance on some factors in determining reasonable compensation. Once again, they're not going to tell you what to pay yourself, but they're going to give you some criteria for you to consider in determining reasonable compensation. And so here's basically the criteria. The first criteria is training and experience. So generally speaking, depending on what your background is in your S corporation, training experience will play a factor in determining reasonable compensation. The second factor they're going to give you is basically duties and responsibilities. How much responsibility do you have? Do you have an S corp owner who isn't as involved in the S corp yet has to pay themselves a reasonable compensation? Well, maybe they don't receive as much of a wage as the other ones that are much more involved in the S corporations. Time and effort devoted to the business. Are you an S corp owner that basically is involved 100% of the time? That's going to obviously play into how much you're going to pay yourself. Dividend history. Now, this one's interesting. Now, this is if you've been around for a little while and you've been taking out dividends out of your LLC or your Inc. So the IRS will look and they'll say, you've been distributing, $50,000 a year, $100,000 a year for the past 5 years. Clearly, you can pay yourself, either $50,000 a year or $100,000 a year. So, you need to come up with a reasonable compensation, some sort of W-2 wage that is kind of in conjunction with your dividend history. So if you take out $100,000 a year and you give yourself $10,000 a year in a Form W-2, the IRS is going to say, well, you can clearly afford much more of a W-2 because your dividend history has always been $100,000 a year. The next factor here is payments to non-shareholder employees. Once again, what does everyone else get paid in your business? So you have 6 employees and they all get paid $80,000 a year because that's kind of what your industry generally pays for someone their skill set, and you pay yourself $20,000 a year because you're trying to optimize your S corp. Well, obviously that's a glaring indication of having an unreasonable compensation. So they also look at payments to non-shareholder employees. That is, what is everyone else getting paid versus what you're getting paid in your own business. Timing and manner of paying bonuses to key employees. Once again, they're basically looking at other employees and they're trying to find a benchmark, and that's how you're going to determine your own reasonable compensation. What comparable other businesses pay for similar services? So I'm in the accounting industry. What do other accountants get paid? Do they get paid $50,000 a year? Do they get paid $100,000 a year? What's the average salary for somebody in my industry? Well, what's the average salary for someone in your industry? Now, generally, if you're not making enough to pay yourself what your industry can pay you, that's obviously a factor in determining your reasonable compensation, which actually falls into the last point here. Compensation agreements. Is there an agreement between your company and you? That is, was there an official document that says, hey, Will Lopez, you're going to start your own LLC, you're going to elect S Corp status, and the LLC is going to pay you $50,000 a year in form W-2 wages? That is there an actual document that arranges the compensation? And the last point, which is generally where a lot of people fall into, is the use of a formula to determine compensation. I call this basically, i.e., a budget, right? The use of a formula to determine compensation. Generally, a budget is what drives how much you can pay yourself, because a lot of people own businesses where they need working capital to buy inventory or to keep their businesses running, or they need working capital to pay other employees or to keep cash in the business. And there's only so much that the shareholder employer can pay themselves as far as reasonable compensation, because you have a formula to determine your own compensation. That is, let's say you take whatever's left because everything else is needed to run the business. The last point is where our firm really suggests that if you're new to your S Corp status or if you're new to starting a business, you connect with an excellent tax accountant or an excellent tax planning firm to help you determine the formula for determining reasonable compensation. So here's some red flags that trigger an audit regarding reasonable compensation. So let's say you're 1 year in, 2 years in, 3 years in, and you've decided that you're just going to pay yourself whatever. So I want to let you guys know that there are some red flags that can trigger an audit when you're an S Corp and you're either running reasonable compensation or you're not running compensation at all. That is, you're getting the benefits of the S corporation, but you're not paying any wages at all. And so basically the warnings are just this: zero reasonable compensation in large distributions. So what does this basically say? No W-2, so you've elected S Corp status, no W-2, yet you're taking a lot of money in distributions. Huge red flag. Could definitely trigger an audit. See this happen all the time. We had a client that basically came to us 10 years later after being an S Corp for 10 years, never ran a reasonable compensation, and it did trigger an audit. Second point here, low salary versus distributions. This is a big one as well. So some of the case studies where the IRS has come in and imputed and redirected distributions to salary are because people that ran low salary compared to distributions. So let's say there's enough cash in the business for you to pay yourself $200,000 a year in distributions. And then you talk to me or you talk to another professional accountant and you say, well, I'm going to run myself a salary. I'm going to pay myself $5,000 a year in W-2 because I want to pay as little of Social Security and Medicare taxes as I can pay. Well, that is a big red flag for the IRS. They can definitely catch you on that because you have to file a corporate tax return for your S Corp and you have to file your own personal tax return. And all they have to do is compare your low salary to your high distributions, which also gets disclosed on your corporate tax return, and they can quickly find out that you're running an unreasonable compensation. And your ratios are out of line. So this is another one where depending on the agent that you get or depending on the IRS on what they're kind of looking at, generally there's 3 ratios that fall out of line that make it look like you're running unreasonable compensation. The first ratio is basically sales to compensation. So making a lot of money. If your compensation is very low, well, if you're making a lot of sales or if your sales are high and your compensation is low, that ratio looks out of line. Generally, the higher the income, the higher the compensation. The lower the income, the lower the compensation. So, pretty straightforward, but be mindful of that. Second point, distributions versus compensation. So once again, I pay myself $10,000 a year in Form W-2, but I take $250,000 a year in distributions. That ratio looks totally out of line, looks very unreasonable. Versus I pay myself, let's say, $100,000 a year in W-2 wages, and I take out $100,000 a year in distributions. 50-50 split looks very reasonable. Third point, profits versus compensation. Another indication. What's your bottom line look like? Does your bottom line indicate that you have the ability to pay yourself something decent as a shareholder employee? Let's say your bottom line is $500,000. Well, if you're paying yourself a $10,000 W-2, clearly you can afford a much higher W-2 than $10,000. So, if your profits are high and your compensation is low, that's an indication of unreasonable compensation. Whereas if your profits are high, compensation's high, it looks reasonable. Profits are low, compensation's low. Obviously, that makes sense as well. So who cares? Why should we care about, these red flags or these kind of ratios or indications? Well, because the IRS can recharacterize what was actually paid out in distributions to compensation. So a lot of people will say, well, what's the worst that can happen? What's the IRS going to do? Am I going to be thrown in jail? Well, some people are thrown in jail. The most egregious cases, some people get time. But in many situations, what happens is the IRS recharacterizes distributions that were paid to you as compensation. So what does that basically mean? Well, let's say I had an S Corp and I paid myself a $10,000 W-2 back in 2016. But I paid myself about $250,000. I took out $250,000 of cash distributions out of my business. Well, the IRS can come in and say, okay, your compensation looks very unreasonable. We're going to redirect $100,000 away from your distributions according to your corporate tax return, and we're going to pretend that you should have paid yourself $110,000 in W-2 wages. Therefore, you owe us Social Security, Medicare tax, both the employee's portion and the employer's portion on that additional $100,000, and all unemployment taxes, federal and state, and penalties, interest, and fines. So what will happen is, while you may not be thrown in jail, obviously don't be the most egregious offender out there, obviously not. You don't want to do unreasonable compensation. But if they end up catching you, what will happen is, for the most part, generally speaking, they will redirect distributions as compensation, and they will charge you back Social Security, back Medicare, penalties, interest, fines, both federal and state. So not a place to be. Very aggressive when it comes to the cash requirements and the penalties and fines that come with it. So surviving a reasonable compensation challenge. Well, how do we survive one? Let's say I'm running reasonable compensation. I'm doing everything right. I've connected with a tax accountant. I've connected with a tax planning firm that has allowed me to run reasonable compensation. When I get questioned, how do I survive one? Well, what we try to promote around here is obviously be very proactive. Don't guess. Work with someone. Speak with someone. Speak with an accountant. Speak with a tax planning firm. Research and document how you arrived at your reasonable compensation. Don't just take a dartboard and throw a dart at it and say, boom, there it is, $30,000 a year, that's what I'm going to pay myself. No, don't do that at all. You're going to get yourself in trouble. Research and document how you arrived at reasonable compensation. And lastly, what we like, what I love, what I recommend and promote to all business owners is do tax planning. One of the best ways of surviving a reasonable compensation challenge is obviously being proactive, researching and documenting, but doing a tax plan, and that tax plan becomes part of your arsenal of documentation and your research for determining reasonable compensation. Super helpful. We do it with a ton of clients. It's extremely beneficial for you as a business owner, as a shareholder employee of an S Corp business. So here's my opinion. Here's what I would recommend for surviving, obviously, an audit. Generally speaking, a reasonable compensation. My opinion is this. Tax planning is extremely beneficial for reasonable compensation. It helps determine reasonable compensation. It allows you to reverse engineer what your reasonable compensation is, especially if you're new, especially if you don't know what to pay yourself, or especially if you don't have the profits, you don't have the income to pay yourself what someone generally gets paid in your industry. So tax planning is an extremely beneficial way for you to reverse engineer reasonable compensation and get that documented and that research and being very proactive in determining reasonable compensation. Secondly, it helps you calculate new quarterly personal estimated tax payments. So what a tax plan can also do is not only reverse engineer reasonable compensation, but it can also reverse engineer how much to pay pay in as far as quarterly personal estimated taxes, both federally and state. So when we do tax plans for individuals, it answers this basically the three situations. One is it helps reverse engineer reasonable compensation. Secondly, because a tax plan is a forecast of your S-corp profits and other W-2 income and other forms of income, it's basically like a fake personal tax return. That's what a tax plan is, a fake personal tax return that's done in advance very proactively. It helps re-engineer your new quarterly estimated personal tax payments federally and state. So very useful if you've been let's say an LLC for a long time as a sole proprietorship or a partnership, yet you're new to the S-corp front. Well, if you're new to the S-corp election tax classification, well, that obviously changes the parameters of your estimated tax payments. Well, when you do a tax plan considering the new situation, it helps basically re-engineer, reset your quarterly estimated payments in advance. See, when you work with people in my industry, they work using historical data. So they'll use your 2015 tax returns to give you vouchers, estimated payment tax vouchers for 2016. Or they use your 2016 tax return to give you vouchers for 2017. Well, if your business does well, those vouchers are very unhelpful, not useful at all. So tax planning basically plans for 2017 into the future, looking at how the business is performing and is able to give you new estimated payments federally and state that use real-time figures. Super, super helpful for a lot of business owners. Thirdly, provides early opportunities to discuss cutting taxes. So we attack tax planning to help people determine a reasonable compensation, reverse engineer how to get there, especially if you don't have the cash to pay yourself what you should pay yourself. Helps too with your new quarterly personal estimated payments, federal and state. And the third one is because you're talking about a year that has not ended, like 2016 or 2017. So if you're doing tax planning now, or if you do tax planning, let's say with our firm, we actually have a conversation about your 2017. It allows us to have early opportunities to discuss cutting taxes, which is generally an experience that no one ever experiences when they're working with their accountant. Generally speaking, when this kind of conversation happens, it happens in the next year. It happens in February of 2018, March of 2018, April of 2018, right at the end of the tax deadline, April 15th. How do I lower my taxes? By then, there's just not much an accountant can do to really answer that question effectively. But if you do tax planning and you do it in advance, we can actually have a very solid discussion on how to cut taxes early, way ahead of time, and how to implement those tax cutting opportunities and actually filter it through your tax plan and show you how much savings you're going to get because of it. Super, super helpful. So tax planning conquers three things for you. Helps document your reasonable compensation in your proactive attempt to be to gather research and documentation. It helps provide early opportunities to discuss cutting taxes with your accountant and with your tax planner. And 3, it helps recalculate your quarterly estimated payments, both federally and state. Super helpful. That's why we recommend it greatly. Lastly, I want to talk about basically software recommendations. So let's say you're ready to roll through running payroll. You've done a tax plan. Or let's say, you want to wing it yourself. Well, what do you recommend as far as payroll? Who do I use? Do I use my accountant? Do I do it on myself? Listen, guys, payroll is extremely complex. You do not want to do this on your own. Believe me. I don't want to do it for you manually. I'm never going to do anything like that for our clients. But I am going to recommend some solid software that's out there that will help automate this tax planning, payroll processing, an extremely cutting edge technology, integrates with some of the greatest accounting software out there. You don't ever want to directly tackle payroll on your own. It's a disaster if you mess it up on your own. It's extremely complex. The states are not forgiving. States want their unemployment taxes. Federal government wants its employment taxes. Department of Labor is all over corporations when it comes to this kind of stuff. If you did this manually, you would have to file somewhere between 5 and 10 federal payroll tax forms every single year and 5 and 10 state payroll tax forms every single year. So if you do this manually, you're literally going to subject yourself to somewhere between 15 and 20 payroll tax documents every single year. You're not going to want to do that. So my recommendation for software, awesome company out of California. They're called Gusto. Sometimes people call it Gusto. But you can go to gusto.com. There's actually a link down in the description that can redirect you. Check it out. What's really cool, maybe I'll jump on their website here real quick and we can kind of maneuver around. But gusto.com is the payroll company of choice that I recommend. What's really cool about Gusto is they actually have an autopilot feature. So let's say, our firm does tax planning for you. We say, hey, you're going to pay yourself $50,000 a year for 2017. We've determined it. We've documented it. We've discussed it. We figured it out. We go in gusto.com. We actually set the salary and we turn on autopilot. Basically, it runs payroll for you automatically. It pays your payroll taxes for you automatically. And it submits your payroll tax forms for you automatically. I mean, you can't get any better than this. It covers your federal, it covers your state, it covers your federal unemployment taxes, employment taxes, withholding taxes, and state unemployment taxes, withholding taxes. Super helpful. It scales with you, small cost per employee, but this is the payroll software choice that we would totally recommend. It actually integrates with Xero.com. Xero.com, which is an awesome accounting software. So if you're considering accounting software, Xero.com is where to go. But check out gusto.com. There's a link in the description, or there's actually a web link here on the video. Check it out. We'd love for you guys to see it in action, especially when you're considering reasonable compensation. Well, guys, thanks for joining us on this video. Check us out for the next one. See you guys later. Hey, thanks for watching. Hopefully we were able to answer all your questions. Be sure to click on the subscribe button down below to follow us for future video releases. Check out this video up here for our best recommended video for you. And right underneath it, check out our playlist, which is our best recommended playlist. See you guys on the next video.